Let me welcome on board then Ryan Sweet and talk a little bit more about the commentary coming in out of the Jackson Hole Symposium. Ryan, hi, good morning. Good to have you on the show. We just heard Jerome Powell remaining dovish, preparing the market for taper, saying that taper is near, but also reassuring the market that it's not going to be sudden but gradual. What are you making of the commentary? And then, of course, the market and the 10-year paper reaction.
I think overall, on net, Powell was overall, he was dovish in his Jackson Hole speech. The acknowledgement that we could taper late this year, the Fed could taper late this year, I don't think was really surprising. I think markets were starting to bet on, either a November or December start for the taper. And when it does begin, the Fed has signaled that it's going to be on autopilot unless something goes wrong in financial markets or the economy. So it's going to be this gradual reduction from 120 billion per month down to zero. It'll probably take 12 months, 11, 12 months to complete. I think the most important part of his speech was he divorced balance sheet policy from interest rate policy. And I think that was very key for the market response, because if you go back to 2013 when we had a taper tantrum, when long-term interest rates spiked because the bond market read into Bernanke's comments that tapering is coming, they also inferred that means interest rate hikes are coming sooner than previously thought. This time around, Powell divorced the two, and I think that was very, very important communication on his part.
Okay. Hi, Ryan. This is Mubina as well joining in. What explains that weakness coming in the dollar index when Powell has said that, look, tapering is coming. We're going to cut down on purchasing those $120 billion of bonds?
Well, I think it's partly because the long end of the yield curve came down after Powell's comments. And, I think if you, read through his comments a couple of times, it's really the inflation part that was dovish. He is doubling down on the recent acceleration in inflation in the U.S. is transitory. It's attributed to temporary factors, the reopening of the economy, which hopefully is just a one-time event. That's boosting prices for transportation, lodging away from home, so hotels, motels. Rental car prices are rising very, very quickly. And then we have supply side constraints. So we have the global semiconductor shortage that's driving up a lot of prices for goods in electronics to new and used vehicle prices. This might linger a little bit longer than many economists anticipate, even the Fed, but this is also temporary. Once we get supply chains back up and running, that's going to be disinflationary. And Powell laid out 4 or 5 points on why this is likely going to be a temporary acceleration in inflation, and that inflation should return to the Fed's target in next year and in 2023. I think that is a little bit more dovish than the market was anticipating, since we've gotten a few hot CPI numbers. But I would agree with Powell. I'm not concerned about inflation consistently running well above the Fed's target. We're going to see some moderation in U.S. inflation first half of next year into the second half of 2022.
Ryan, good to have you on the show. Thanks as always for taking the time out and speaking with us this morning.
Take care.